Hello once again, everyone. I am here to talk to you guys today a little bit about what's going on in the markets, your current statements, what you can expect to see on those statements, what we're doing moving forward, and what we've been doing throughout this as well. So the first thing I'm going to talk a little bit about is statements. Client statements for the first quarter are available now. They are being mailed out this week and published online. So everybody will have access to those statements and be able to see what your particular portfolios have done. So they are going to be bad. There's no real sugarcoating that. Statements are going to be down. The reality is pretty well everything is down. The Canadian market, the TSX, was down 23% this quarter. So even if your portfolio is not down the same amount as the index, 75%, 50%, it's all going to hurt. Let's be honest about that. So things to keep in mind with that, why it's down, and just a little bit of an explanation on that is where I wanted to start today. So the equity markets are, of course, down across the entire world, and we're really seeing that in the portfolios as well, and you will see the equity components down. Fixed income has also been hit, and the reason fixed income has been hit is because of this. So fixed income, or bonds typically is the term you use, is debt that is owed by either a government or a company that has to be repaid. And as they repay that debt, that payment goes into the fund, and that's that income that's coming in. So thus the name fixed income. And that income continues, and that's one portion of the value. But another portion of the value is people's expectations about that income and people trading the value that they perceive attached to those bonds, which is what a bond fund or a bond market does. So when there's a market crash, when there is concern over whether or not people will be able to repay that debt, those funds are also affected. They get affected by emotional selling. Whether or not governments have promised billions, trillions of dollars in some cases to ensure that these companies can pay these debts and they don't go bankrupt and we don't have a mass amount of bankruptcy, doesn't really factor into the short-term panic and selling of these funds that, of course, you guys feel and see in your portfolio. Another place you're going to see a little bit of a hit that is typically not expected is our real property fund. So real property is usually a great hedge. It usually works very much not in the same direction as the market because real property holds actual buildings, rental units in Canada. The reason for the drop at this point was a revaluation to be conservative with the concern of rent not being paid. Again, whether or not the government helps subsidize that, there is that concern out there, as well as what will the demand be for some of this office space moving forward out of this, people working from home. That being said, I personally will tell you that I am very excited to the concept of being back in the office, working in an ergonomic environment without my kids in the background distracting me or yelling every time I go down for a coffee and can't stay to play. And I happen to know a lot of other people who feel the same way. So I will be increasing the demand when this ends, but there is still concern over that. So we have seen that downturn right now, and that will also, of course, be affecting your portfolios. That said, there is a downturn. It is going to be negative, but it's not all bad news. What have we been doing to manage through this, move forward? Really, your portfolios aren't down the same amount as all the indexes are. So how has that been the case, and how do we expect the rebounds to come on the flip side of this? So with everything going on, we have had lots of contact with our leadership team and portfolio managers. Our call on Monday, we had the opportunity to hear from Jeff, who's a portfolio manager of the US equity division at T. Rowe Price. Andrew, president and CEO, portfolio manager, Fidelity Canada Asset Management, as well as Darren, who's the senior VP and head of global equity and income team for Mackenzie Investments. And they were able to share with us a little bit about what they've been doing to get through this, what their strategies are moving forward, and some of the things they're considering. So on the US side of things and what they're looking at, really right now, they're looking at balance sheets. Companies that are poised to get through this, that have strong balance sheets to make it through. The example they gave was McDonald's. So does McDonald's have the balance sheet to get through closures in some of Europe, converting to drive-through only in many places? And if they do have the balance sheets to get through that, what's it going to look like on the flip side? Is there opportunity to pick up market share from companies that weren't in such a good position going into this? Is there going to be an increase in people who have now gotten a taste and started really doing that? If that's the case, then they would be a good buy. And those are the types of scenarios that they're working through and looking through. They're also looking for beat up cyclicals. So opportunities again to get companies at really good valuations because of everything that is going on right now. On the global side of things, talking to Darren, their team has actually changed a 20% turnover since mid-February in their portfolio. That is actually huge. And the reason for that turnaround is that they have what they call their dream team of companies that they want to buy into. That is a list of companies that they follow and are extremely knowledgeable about. They know the balance sheets inside and out. They know all the financials. They've talked to the management team, the directors, and they watch these over the long term. And a lot of these companies, they haven't had in the portfolios in the past, not because they didn't believe in the companies and the long-term success, but because they didn't like the valuations. They didn't like the prices they were selling at. So there's two ways to look at the value of a company. One is do your homework and know the value. The other is through emotion. And those swings that we've been seeing, there have been some companies that have opened the day at down 10% and added the day at up 10%. A 20% swing is not a change in profitability and value of those companies. It's emotion, it's buying and selling. So they've had the opportunity to buy some of these companies at valuations that they believe are really, truly good valuations and fair for those companies. One example they gave was a particular company that they've actually been following since 1998 that has now hit the valuation that they believe is fair and have added back to that portfolio. So really watching for opportunities to buy, opportunities to pick things up. They're also watching for when this turnaround could potentially happen. Now, nobody has a crystal ball. Nobody's pretending to have a crystal ball. I mean, really, we have to get the virus and the healthcare under control and the fear under control there, which will then sort of be the missing link with all of the other government promises, all of the stimulus that's really been put into this. It's the healthcare that seems to be the missing link at this time. So they're watching but they're watching where they believe the recoveries also will happen. So we heard a little bit about how since 2008, US consumers have actually reduced consumer debt, whereas Canadian consumers have increased consumer debt. So looking at that and what do they think that means for consumer sentiment and people going out and buying after this is over? Will Canadians be a little bit more fearful for a little bit longer at the opportunity of job loss and what that can mean with their debt levels versus the US that may jump right back into buying right away? These are the kinds of things they're looking at and really trying to make sure that they're poised to take advantage of that. So that's taking advantage of it. We've been doing that all the way through. That's really looking ahead to the future. But what they've also been doing, of course, is managing through the volatility. As I mentioned, this volatility is here, probably here to stay for at least a little bit longer. So what have they been doing in the past that they're going to continue to do to deal with this? One thing that our fund managers have been doing, and they've been doing this all the way through in the past, which has also really helped, and one of the reasons why your portfolios will not be down as much as indices and markets have been, is they use options. So really simplified, options are something that can be used where you aren't greedy on the uptake, you give a little bit of benefit on the uptake to protect from the down. So when markets are going and everything's good and steady, you take a little bit of funds that instead of putting into the market, you say, we're going to buy options. If the market keeps going good and steady, those options will be out of the money. They'll be worthless when they come due. And we gave up a little bit on the up to make sure we weren't too greedy and protected the down. On the downside, which is what we've seen, what happens is the market has a correction. We see that volatility, we see that plunge. Well, now those options are what you call in the money. They have value when they come due. So what they've been able to do is take that value, take that cash and inject it into the portfolios. That cash injection allows them to do a few things: buy when opportunities are good, but also to hold some cash balances in our portfolios, have reserves, which allow us to have access and liquidity for drawdowns. So when people are taking money out and wanting money out, we're not having to necessarily sell good companies that we want to hold at a low and crystallizing those losses. So it's another benefit of these actively managed portfolios versus just holding, call it 10 different companies that you have to sell all the good, the bad, and the ugly when you sell a chunk of, right? It allows them that opportunity. It's really, long-term planning, and we're using it to reduce volatility. So we want to make sure we're able to continue to do that. The other thing we're doing is planning. And I don't think I can say it enough. Good planning makes a huge difference. It makes a huge difference in the positive world, but it makes an even bigger difference in difficult times like these. And we've really seen what that planning can do over the last little bit. So in 2008, when the market crashed, early 2009, we have all the numbers and the statistics that show the market in general had more outflows or redemptions than inflows. So it was in what we call net redemptions. More people were taking out money, crystallizing losses during that whole downturn than were putting money in and buying low. IG was actually not in that scenario. We had more clients putting in money than we had taking out. We had clients taking that opportunity to buy low. And as we know, the market did come back. They bought in at that lower point and therefore benefited from it. We're starting to see the same numbers again now. People are pulling out of markets. People are getting scared. They're getting nervous, and they're taking their money out, and they are crystallizing those losses. Our clients on the flip side are not. Our clients are looking to increase contributions, given that they can't spend as much money going out to, restaurants and movies and all those things. You got a little extra cash. They're increasing contributions either on a monthly basis for some expenses that have been eliminated, daycare, those types of things, or lump sums. Hey, at the end of this month, we have an extra couple $100, couple $1,000 because we didn't spend it. Can we throw it in? Can we buy low? We've seen some of our senior clients reduce the RIF payments. Again, they're not spending as much, leaving it in there to come back up. So a lot of these things are really helping, and we'll see what those look like long term.